We're standing at the edge of an economic transformation unlike anything we've ever witnessed. While most investors are still anchored in the past, watching the same indices, the same companies, and the same narratives, the real story is unfolding in the undercurrents of disruption. When people start believing that one currency will hold its value forever, that's usually the moment it begins to slip. History has taught us that no paper currency is immune to time, politics, or human error. Every empire that believed its currency was indestructible eventually found out the hard way that confidence can fade faster than gold can tarnish. Money, at its core, is simply trust, and trust is fragile. Over a lifetime of observing markets, I've seen that the smartest investors aren't the ones who try to predict the next dollar movement. They're the ones who understand that currencies come and go, but real value endures. The US dollar, strong as it has been, is not exempt from the rules of economic gravity. When a nation spends beyond its means and prints its way out of every crisis, the purchasing power of its currency quietly erodes. It doesn't happen overnight, and that's what makes it dangerous. The loss is slow, silent, and often unnoticed until it's too late. Putting all your wealth, savings, and security in one form of currency is like building a house on one pillar. It stands tall until the day that pillar weakens. Diversifying isn't about fear, it's about prudence. The world changes, governments change, policies change. What was safe yesterday may not be safe tomorrow. The best investors know this and adjust accordingly, spreading their assets across borders, across industries, and across real, tangible things that can't be printed out of thin air. There's a certain comfort in believing your home currency will always be reliable. It feels patriotic, even practical. But emotions don't protect wealth. Discipline does. If you look back, even the greatest currencies, the British pound, the Roman denarius, the French franc, all had their seasons of strength before decline set in. The pattern is as old as civilization itself. When debt grows faster than productivity, the currency begins to falter. It's not about losing faith in your country or its economy, it's about recognizing cycles. When a currency weakens, it doesn't mean opportunity disappears, it simply shifts. Those who understand this move early. They hold real assets, businesses that produce, land that yields, metals that endure, and investments that grow regardless of which flag is printed on the bill. The goal isn't to run from risk, but to manage it intelligently. You don't need to abandon your currency, just don't worship it. Treat it as a tool, not a treasure. Value what it can buy today, but never assume it will buy the same tomorrow. Inflation is the quiet thief of certainty, and it doesn't knock before entering. So, when you think about the future, remember, wealth isn't measured in the number of notes you hold, but in the strength of what those notes represent. The world has seen currencies rise and fall, but the people who hold on to value, through patience, prudence, and perspective, never go broke. The smartest thing anyone can do in uncertain times is to own something real. Paper promises have their place, but they can vanish with a policy shift or a printing press. Real assets, on the other hand, have a way of holding their ground when everything else feels shaky. Land, productive businesses, and tangible goods have intrinsic value. They don't depend on someone else's signature or promise to pay. They work for you quietly, day after day, no matter what the markets are doing. There's something steadying about owning things you can see, touch, or understand. A productive farm, a well-run company, a rental property, or even a factory, these aren't just numbers on a screen. They generate cash flow, create utility, and provide stability. When people chase quick gains in speculative paper assets, they forget that real wealth doesn't come from motion, it comes from substance. Ownership of real things anchors your financial life to something that won't evaporate with a bad quarter or a government announcement. Over the years, I've learned that every time money loses credibility, tangible assets rise in importance. When confidence in paper fades, people run back to what's real. It's been that way for centuries. When times are good, people forget this rule. When times are bad, they remember it instantly. If you own a business that produces something people need, you're better protected than those holding pieces of paper that depend on others to deliver value. Real ownership also teaches patience. You can't flip a farm overnight, and you shouldn't want to. It takes time for crops to grow, factories to improve, or companies to mature. But the reward for patience is compounding value. You're not betting on trends. You're participating in the creation of real wealth. That's how fortunes survive generations, not through speculation, but through ownership of assets that endure. The trouble with paper wealth is that it often feels bigger than it is. It looks impressive on a statement, but its value depends entirely on sentiment. The moment fear enters the market, paper melts away faster than people expect. Real assets behave differently. They may fluctuate in price, but they rarely lose their usefulness. People will always need food, shelter, energy, and tools. If you own something that meets a fundamental human need, you'll never be far from demand. In an age where everything feels digital, it's easy to forget that the real economy still runs on physical things. Factories still make, farms still grow, people still build. The world can shift toward technology and algorithms, but even those rely on minerals, land, and energy. When you own the foundation, you don't worry as much about the roof shaking. So when uncertainty grows, don't seek safety in promises. Seek it in production. Own things that last, things that serve, things that build. The markets can swing wildly, currencies can lose strength, and confidence can fade, but the ground beneath something real never disappears. Putting all your faith in one idea, one stock, or one market is like sailing with no lifeboat. It feels efficient while the weather's calm. But when the storm comes, and it always does, you realize how exposed you are. Diversification isn't about being clever, it's about being wise. It's protection against the unknown, a recognition that even the best judgment can be wrong. No one, no matter how skilled, can predict every turn the world will take. Overconfidence is one of the most expensive traits an investor can have. The moment you believe you're certain about the future, the market will find a way to humble you. Spreading your risk doesn't mean you don't believe in your investments, it means you respect uncertainty. The world doesn't move in straight lines. Industries fall out of favor, governments change policy, technologies shift overnight. The people who survive those changes are the ones who didn't bet their future on a single outcome. The beauty of diversification is that it buys time. When one area struggles, another may thrive. You don't need to predict which one. It happens naturally when you spread your bets wisely. That time gives you breathing room to stay calm while others panic. You can hold through downturns instead of selling in fear, because you know your entire ship isn't sinking, just one section taking on water. It's easy to dismiss diversification when things are going well. When a particular investment keeps rising, people convince themselves they don't need balance. They forget that success breeds complacency. The markets reward patience but punish arrogance. Those who diversify during good times don't get the same applause, but they sleep better when the tide turns. Diversification doesn't mean scattering money blindly. It means understanding the rhythm of different assets and how they behave in various conditions. Stocks, bonds, real estate, commodities, even cash, they each play a role. A business owner knows not to rely on one supplier. An investor should think the same way about income and growth. The goal isn't to own everything, it's to own wisely across areas that don't rise and fall together. Over a lifetime, markets will test your discipline more than your intelligence. The headlines will tempt you to chase what's hot or to double down on what worked last year. But the ones who last are those who build portfolios like sturdy bridges with multiple supports beneath them. When one beam weakens, the whole structure still stands. In the end, diversification is the quiet guardian of wealth. It doesn't make headlines, it doesn't promise overnight success, and it won't make you feel like a genius. But it keeps you in the game. That's what matters most. Because in investing, survival is underrated. You don't have to win every year to build lasting wealth. You just have to avoid losing everything when the unexpected happens. Diversification makes sure you can do just that. The world doesn't move in straight lines, it moves in cycles, periods of optimism and fear, growth and contraction, greed and caution. Anyone who's been around long enough has seen it happen again and again. Yet every time the tide turns, people act as though it's the first time. Thinking long-term means accepting that cycles aren't to be feared, they're to be understood and used to your advantage. Markets are emotional creatures. They swing between euphoria and despair, but value sits quietly in the middle, waiting for patient hands. Most investors chase what's already happened. They buy when prices are high because everyone else is buying, and they sell when prices fall because they can't stand the pain. But wealth isn't built in the frenzy. It's built in the calm between the storms. If you can look beyond the next quarter or the next headline, you'll find opportunities that others can't see. The problem is that short-term thinking feels exciting. It gives you the illusion of control. Watching screens, reacting to news, trading on every tick. It feels like you're doing something. But activity and achievement aren't the same thing. The best results in investing often come from sitting still while others are running around. The longer your time horizon, the more predictable outcomes become. Over years, markets reward value and discipline. Over weeks, they reward luck. Cycles aren't accidents, they're built into human behavior. When times are good, people borrow too much, spend too freely, and convince themselves it will last forever. When times turn bad, they swing to the opposite extreme, cutting, hoarding, and abandoning reason altogether. The investor who understands this rhythm doesn't get caught in either emotion. They know that downturns create bargains and booms create bubbles. Patience is their shield, and time is their ally. Thinking long-term doesn't mean ignoring the present, it means seeing it in context. Every market correction in history has looked permanent while it was happening, but over a decade, those dips fade into small notches on a chart. What feels like disaster in the moment often becomes the very opportunity that defines your success later on. The market rewards endurance, not speed. One of the most valuable skills any investor can develop is emotional stability. You can't control cycles, but you can control how you react to them. When others panic, keep perspective. When others are euphoric, stay humble. The hardest times to invest are often the best times to buy, and the easiest times to invest are usually the worst times to add. That's the paradox of cycles. So, think in decades, not days. Build for the long game. Let compounding work quietly in the background while the noise of the market comes and goes. Time is the greatest filter. It washes away speculation and leaves only truth. Those who understand cycles don't just survive them, they thrive because of them.